You've probably heard something along the lines of the fact that prices keep going up and inflation is getting out of hand because the government won't stop printing money. But how exactly does this work, and where does all of this money actually come from? I'm Keith D, and on this channel we talk everything money and markets. Let's break down where money actually comes from and why it matters now more than ever. Before we can dive deep into where money comes from, let's take a second to think about what money actually is. Money didn't start off as dollars or as gold. It really all started with a specific problem: barter. Trading grain for goats works just fine until the grain guy doesn't want your goats. And economists call this the double coincidence of wants, where two independent parties actually possess something that the other wants, and therefore can conduct a mutually beneficial trade. So without this double coincidence of wants, trade can get kind of difficult because one person doesn't want what the other person has. And that's where money came from. It was to address this idea that you don't need to have what the other person wants in order to still make a trade. Economists define money by three core functions. The first being a unit of account, meaning that we need a common language to price things in. So for instance, how many goats are worth how much grain? Second, it needs to be a medium of exchange, meaning that people need to actually accept what it is that you're offering in exchange for the goods that they're providing or offering. If no one wants it, then it's not money. Third, money has to be a store of value, meaning that you can have the money and save it and then use it at a later date. But good money also shares four key traits. It's durable, divisible, portable, and fungible. In a barter system, it's extremely inefficient and it's not scalable. But then we get to what's called commodity money. So imagine trading in cattle or trading in wheat. Now the problem with commodity money is that first, it can be hard to transport. So let's say you're using cattle as money. Well, cattle, they don't always do what you tell them to do, and they are extremely heavy. So trying to get cattle, in your bag could be a little bit difficult. Another problem with commodity money is that it's not durable. So unfortunately, cattle is livestock and cattle could die. And for that reason, it's not necessarily the best way to store your value, if that makes any sense. On top of that, good money has to be divisible. So, you could butcher the cow and chop it up into pieces, but that's just not what we're trying to do here. And lastly, commodity money is not necessarily super fungible. So one cow might be much larger than another cow, and therefore you can't exchange them as one solid value or unit of account. Eventually, we moved into coinage as money. So little coins that were made of metal that essentially were stamped upon by some sort of a king or ruler of the time. And these empires would say, hey, this is money and it has value. Now, sometimes, this money had intrinsic value in terms of like gold or silver having this industrial use case. But at the same time, this was the beginning of fiat money. The reason we moved to this coinage was because it's much more portable. Now you can actually take your coins and put it in a bag. And depending upon what metal the coin was made of, it might be a little bit more durable. And most importantly, coins were fungible. So if you had a specific coin that had a specific amount of metal in it, then you could know for a fact that that is worth the same coin that has those same exact traits. Then we moved on to backing our paper notes with physical commodities like gold. This made trade even easier to where you could have just a piece of paper that represented thousands of tons of gold, if that were the way that we did it. And then that very swiftly led to purely fiat money that was backed by nothing other than trust in the government or the institution that is issuing that currency. Now, this matters a lot because when you have nothing backing the currency, then the supply of that currency can basically go up and down based upon whatever. Whereas when you have a physical commodity like gold, for instance, the only way to increase the supply of gold in the system is to actually go out and mine it. And the truth is that system can be self-regulating, because if gold ends up being more expensive, or it buys more things, then people will go out and mine gold because they know that once they mine that gold, they'll be able to use it to get more of something else. Now, if the value of gold declines, then people won't necessarily go out and mine more gold. And therefore, the supply of gold into the system will also naturally slow back down. But fiat money changed everything Because now, instead of money being created through hard work and the energy that it takes to create that money, it is instead created on a whim by policy decisions, credit, and now even just digital entries in a database. In a fiat system, trust in institutions is the foundation of the entire system. But the question today is, how much should we really be trusting these institutions? One of the major misconceptions today is that all money is created through government printing. And while in a way that is true, it's just not exactly how it works. Over 90% of money in circulation today actually comes from commercial bank lending. So here's how it all works. Let's imagine that you ended up with $1,000 and you gave that $1,000 to the bank. In your account, you now see a balance of $1,000, and the bank owes that money to you upon demand. Now let's say someone who doesn't have any money comes into this bank and asks the bank for a loan, and the bank is willing to give them $900, with the idea being that they're still going to maintain a 10% reserve of the money that you gave them as well. Now in reality, that $1,000 isn't actually being touched anyway, because what the bank is going to do is they're actually going to create another $900 and give that to the person who needs the loan. So out of thin air, this person now has $900 that was credited to their account, and you still have the $1,000 in yours. So no one's money was moved. The loan just created new money. So loans create deposits, not the other way around. Now, the problem that could arise is that both you with your $1,000 deposit and the person with the $900 loan wants to get their money out at the same time. Your account still shows $1,000 in the balance, and the person who took the loan also has $900 in their balance. So the bank has now promised $1,900 worth of money that it doesn't have. This is called fractional reserve banking, where a bank only holds a fraction of the cash that they actually have as deposits on hand. Now, today, no one's actually withdrawing physical cash. So these digital bank runs aren't people going to the bank and trying to withdraw physical money from the bank, but instead it could be you on your app tapping, trying to send your money to a different bank account or spend it somewhere. So even though your balance says $1,000, it's really just a digital IOU, and that money could potentially be being lent out to someone else or even invested into the market. So if everyone were to click the transfer button at the same time, then the bank actually wouldn't have all of that money to send out to the depositors of the bank. That money might be locked up in illiquid investments like a loan. So banks today aren't really lending out deposits. What they're doing is they're creating new money. They're doing that within the limits of capital requirements that are imposed upon them and regulatory oversight. Fun fact, because this kind of flew under the radar, in 2020, the actual reserve requirements were lowered to zero. As you can imagine, without any central authority kind of looking over this process of money creation, then things would get really chaotic really fast. And before the Federal Reserve, the banking system was extremely fragmented and also incredibly fragile. Every bank used to issue its own banknotes. And so a lot of the times those banknotes could only really be used locally. So if you had money from the bank and you wanted to use that in a different city or something, then people there might either say, hey, I'm only going to be willing to accept this at a lower than face value because I don't really know anything about that bank. Or they might also just not accept those banknotes at all. The problem was that if they wanted to take that banknote and get the money from that bank, then they would have to know that the bank had that money to give them. And if a bank collapsed, then that banknote would be worthless overnight. So before the Federal Reserve, it was much more common that people would actually lose confidence in whether or not a bank would actually be able to meet their demand for deposits. And in that situation, they would cause what's called a bank run, where everyone rushes to get their money out at the same time. And that led to the collapse of banks left and right throughout the 19th century. And eventually people decided that, hey, we need a thing called a lender of last resort, or someone who can come in and provide liquidity when these moments of panic set in. The Panic of 1907 was pretty much where the line was drawn, and in 1913, Congress in the United States passed the Federal Reserve Act, and the Fed was born with three primary goals. The first being to maintain financial stability, the second to act as a lender of last resort, and finally to manage the supply of money and liquidity within the financial system. All of that was important because this leads to the second way that money is created, which is when the Fed actually purchases assets. But before we can make sense of how these Fed purchases create new money, let's take a second to understand who they're actually buying these assets from and why. There are two key players in the US money system. We have the US Treasury, which conducts fiscal policy, so taxes as well as government spending, and then also borrowing to fund that government spending. And then we have the Federal Reserve, which manages interest rates, also the supply of money or liquidity in the banking system, and the general stability of the financial system. So once again, the US Treasury is responsible for fiscal policy. So it collects taxes from citizens and businesses, and then it also spends money on government programs and so on. And then also it actually is responsible for issuing debt when those expenses exceed the revenues that the government actually makes. So let's walk through this. Citizens and businesses earn income, most of that money coming from the process of credit creation as businesses go out and get loans to go and grow their businesses. These businesses and citizens then pay taxes on these incomes that they've generated, with the idea being that these taxes are the way that the government is actually going to fund its programs. But in reality, these tax receipts are always lower than how much the government is actually spending. And so the Treasury will issue debt in the form of bonds. These bonds are sold to banks, pension funds, even foreign governments, and also the Federal Reserve. So the Federal Reserve System is kind of complicated, and you have this blend of public authority, but then you also have this private participation. And we can get into the weeds of that, but just let me know in the comments and we'll do it later. The important thing to understand is that this hybrid structure is supposed to shield the Fed from being a political institution or from being under the power of the Treasury. And this matters because the Fed is responsible for financial stability. If the Treasury, acting on decisions made by Congress, ramps up spending, it can put upward pressure on inflation. So the Fed needs to be able to act independently and use its tools, like interest rates and quantitative tightening, to bring inflation back down. So how do the Fed and the Treasury actually interact? Well, when the Treasury spends more than it collects in revenues from taxes, then it has to issue bonds. And when there's a slowdown in the demand for those bonds, the Fed will step in and buy as well. So the Fed will create new money, literally prints money in order to buy these treasuries on the secondary market. So they don't buy it from the Treasury, but instead they buy it from banks. And when they're doing that, they're actually injecting new money into the system so that the banks now have money sitting on their balance sheets that came from what was just printed or created by the Fed. This process is called quantitative easing, where the Fed is actually going to buy bonds from banks only with newly created reserves. And then that money is now in the hands of the banks, and those banks can now use that money to lend or invest in the economy. And just like that, new money enters the system. Now, if you're wondering, what about actual physical cash? The Fed can create that too. It doesn't print the bills itself. That job belongs to the Treasury's Bureau of Engraving and Printing. But the Fed actually buys that cash from the Treasury using newly created reserves, the same way that it buys bonds. So yes, even paper money starts as a digital keystroke. So money doesn't just come from government printing, it also comes from credit lending from the commercial banks and also from the actions of the Federal Reserve. Now, that relationship that the Fed has with how banks are actually able to create new money is also a little bit more intricate, and we'll get into that later. But regardless, the Fed being able to just print new money to buy bonds from the government raises a really big issue. Because if the government can raise debt from the Federal Reserve, who can just print new money to buy it, then why would anyone ever even need to pay taxes in the first place if the Fed can just come in and fund all of the government's initiatives? And that question lays the groundwork for trying to get a better understanding of this concept called modern monetary theory, where economists say that a government that issues its own currency is not really limited in its spending by how much it collects in taxes. Instead, the idea would be that spending comes first, where the government will inject money into the economy through spending and infrastructure, and then use taxes as a way to kind of pull the money back out, and also to increase demand for those dollars, because you need dollars to pay taxes. But the problem here is that people are still getting taxed But also, the government is just printing money and buying its own debt. Now, here is where the nuance comes in, because technically the government isn't printing money and it isn't buying its own debt, because the Federal Reserve and the Treasury are two separate entities by design. The Treasury issues debt, and the Fed, which is independent, can choose to buy it if it wants to inject liquidity into the system. So when I say that the government is buying its own debt, what I really meant was that a branch of the public sector, the central bank, is creating new money to finance government deficits indirectly. So even if they weren't collecting taxes, the problem would come in the form of inflation, because when you just keep creating new money and you have more money chasing the same amount of goods, then the value of those dollars goes down and prices rise. So right now we're in this weird place where the government is practicing modern monetary theory, but it never got rid of taxes. And that's the world that we live in right now, because as of today, the Federal Reserve owns somewhere around 20% of all of the national debt. Trillions of dollars of treasuries that were bought with money that was printed out of thin air. Now, all of this can get a little bit complicated, but I'm going to continue to break it down and what it means for money and markets. So if you're new here and you found this helpful, let me know in the comments and like and subscribe. But if you've been around and you don't want to navigate this alone, I have a community where we're doing live economic analysis and updates on what it might mean for money and markets. You can check that out in the description below. Thanks for watching. I'm Keith D, talking everything money and markets. Click here for the next episode.